This is the final video in this series. In the earlier videos, we went through steps 1 through 5 of the revenue standards, both ASC 606 as well as IFRS 15. In this video, we're now going to look at costs, which is also covered by the revenue standards. What you see on your screen is a software that we've developed to help companies understand and implement the requirements of the revenue standards, both ASC 606 as well as IFRS 15. We're going to be using this video, or this software, to help us walk through the requirements. So the first question related to costs that you see is, were incremental costs incurred to acquire the contract? The idea here is that if there were incremental acquisition costs, then in some instances they're required to be capitalized and then amortized over the contract period. The key to this is that the cost must be considered incremental. So the easy test is, if you incurred or entered into the contract, did you incur the costs? And yes, but if you did not enter into the contract, would you have not incurred the costs? And if that's the case, then the costs would be considered incremental. So costs, commission is the most common one, but costs that would not be considered incremental would be if there's a bonus or something to that effect that's paid based upon a pool of contracts. In that instance, if there was no one single contract that you entered into and incurred the cost, but rather it was based upon a pool of contracts. So that type of situation would not be considered an incremental cost. As with all of these videos, we've highlighted the fact that you can select the question mark there and it will give you a summary of what the requirement is, or select the I and it will give you some examples to help you understand and implement the requirements. If you answer no to this first question, so saying no, there were not incremental costs, there is a question that will be skipped here and you'll move to the next aspect of costs, which discusses fulfillment costs. But let's say yes, let's say there were incremental costs that were incurred to acquire the contract. So the next question you're being asked is, are the costs anticipated to be consumed within 1 year, and is it the company's preference to expense as incurred? So the standards provide a practical expedient that says if the costs, had they been capitalized, would have been fully amortized within a year, then you can make a practical expedient election to expense them as incurred rather than capitalize them. One thing I'll note here is that the amortization period, when determining if this 1 year exemption is applicable, has to consider renewal provisions. So the amortization period might be longer than the stated contract term. So you need to give consideration to that when determining whether the practical expedient is available. So let's say, if you said, for example, if you say yes, then you move to the next aspect of cost, which is fulfillment costs. But if you said no, then you're going to be asked to state what the incremental costs were. So let's just say, for purpose of this analysis, we'll say it was $100,000. You're also now asked, of that amount, how much is anticipated to be recoverable? So for purpose of analysis, let's just say $80,000. And the reason you're being asked this is because you're limited to the amount that you can put on your balance sheet to the amount that actually, in fact, would be recoverable. So the next form of cost moves on to fulfillment costs. And these are costs that would be incurred in fulfilling a contract. And we'll talk about specific situations, specific types of costs that would be eligible for capitalization. But the first question is, did you incur costs in fulfilling the contract? Tooling, for example, is one that comes up fairly common. And let's say if you said no, then you move on, and you can see the report is being automatically generated at the bottom. But if you were to say yes, let's say I did incur some fulfillment costs, now you're asked a second question. Are the costs incurred to fill the contract included within other accounting literature? So more often than not, these types of costs are covered elsewhere. They might be covered under capitalization, under intangibles, various other literature. But the purpose of this section of costs within the revenue standards is to capture those costs which are not already being capitalized or not already be accounting for elsewhere. So if you said yes to this question here, or excuse me, if you say no, that it's not accounted for in other literature, then we're directed to certain criteria that if the costs meet those criteria, they'll be capitalized under this literature. If you had said yes, then once again you move on to the report because you've already determined how those costs will be accounted for. If you say no, though, you're asked if these fulfillment costs relate directly to a contract or a specified contract, if they generate or enhance resources of the entity that will be used in satisfying performance obligations in the future, and if they are expected to be recovered. And if you answer yes to those, now you're taken to, similar to what we saw with acquisition costs, how much were those costs? And let's just say they're $50,000 because these will be capitalized. And if you're using this analysis to actually calculate your revenue, you're also going to be asked how much will be amortized to date. If it's analysis only, this section here will not appear.